Traders, today I have my accounting glasses on because we're going deep into the central bank's assets and liabilities. Let's roll the intro. Alright guys, welcome back to another High Impact. It's your boy Cleveland. If you guys haven't seen the last High Impact video, really good response. I really appreciate you guys for liking that. I really appreciate it more than you probably expect. It's kind of weird. I like it a lot, okay? So thank you so much for liking the video, last video and this video. So today we're going to be talking about the central bank balance sheet, alright? And implications of the balance sheet are going to arise on Wednesday, and those are enormous implications, folks, all right? Right now we have $4.5 trillion of assets, okay, that was purchased by the Fed from 2008 to 2014, all right? They actually purchased around $3.9 trillion of different mortgage-backed securities and treasuries in the United States. Don't worry, I got you if you have no rational idea of what that is. But before we move forward, what I mentioned on Monday, I'm going to take these off. I don't really need them, guys. I lied. All right. Before we move forward, what I mentioned on Monday was I was going to tell you guys if I was triggered at any positions from the Monday market breakdown, and currently I am triggered in the US CAT long. You guys saw me say I wanted US CAT long after a break of a certain level. We got triggered in that, and you guys won't know about any intraday positions, but we actually caught an intraday short on the NZD USD, called out by Jesus Nunez. Good job, bro. We were catching a short down from a 23.6 down to a 50% retracement, and it looks like we're actually going to hit off on the 61.8. We liquidated at the 50. Okay, so far this week, so good. All right. So you guys are going to have to keep up with me today because there's a lot of terminology and there's a lot of things that we're going to have to talk about. All right. I'm going to do the best I can to write it up here, but if we miss out on anything, then I'll just throw it with some infographics above. Okay. So what is a balance sheet? A balance sheet is a statement of all the assets and liabilities that a company or entity holds. All right. So what assets and liabilities does the U.S. economy hold? Does the Fed hold? Okay. Well, on the liability side, it's actually cash. It's actually called MO money. It's hard cash, right? So literally money is a liability. It's debt to the government. That debt comes in terms of U.S. securities and mortgage-backed securities from the Treasury. All right, so I'm going to show you guys that process on the board. And as I show you that process, I'm going to basically be exclaiming to you guys how the Fed wants to reduce the balance sheet. They want to take some of those assets and sell those assets back off into the economy, all right? So I'm pretty much done with the prelude here because I want to get to this board and I don't want to have a million infographics up, all right? So let's get to the blackboard. All right, guys, I might have to give you guys a quick history lesson as to why the Fed has an extra $3.9 trillion of assets on its balance sheet, okay? Because that is exactly what they will be tapering. They will be selling off those assets in the quantities of what they hope to be $10 billion a month, and they're going to raise the tapering by $10 billion a month every quarter, okay? So back in 2008, 2007, as you guys know, there was a housing boom and a market collapse. We're not going to go too deep as to why it happened, but it happened. But what we do have to talk about is where they were purchasing assets, okay? So you have two entities. You have Fannie Mae, okay, and Freddie Mac, okay? And those are government-sponsored entities, all right, enterprises. What that basically means is the government created Fannie Mae back in the 1970s because they needed to subsidize lending for the banking system. Again, I'm having a lot of big words here. Basically, if a bank lends out its money, all right, what happens? The bank has no more money to lend. So what the bank can do is the bank can take, here's the bank, all right, the bank can take the money, all right, that it's lent out, the security that it lent out, the actual loan, here's the loan, okay, and you have the bank here, and the bank lends out loans, right, lends out all these loans, okay, so it gives these loans to lenders, okay, and these lenders are doing what? They are giving back interest payments, okay, they may have a 30-year mortgage, a 15-year mortgage, what have you, and they're giving out interest payments, but guess what? What happens when the bank lends out all of its money? The bank then has no more money. So what happens is Fannie Mae comes into the picture and she says, hey, look, I will take those loans and I will buy those loans and I will give you cash. Okay, that's called a whole loan sale. All right, so now what just happened? The bank loans are now owned by Fannie Mae. If you guys have ever been to college, you guys will see Fannie Mae and Freddie Mac if you look at your student loans, because those loans were given to you by the government, okay, via the school as an enterprise, okay? So now those loans are now inside of Fannie Mae. Fannie Mae then does this. She takes all those loans and she packages all those loans up, all right? And those loans are basically securitized. Again, a very big definition. I'll give you guys a little quick link below to give you guys an idea of what that means. So she packages up all these different loans from all these different lenders, right? And then all those different lenders are now working within an entity called a mortgage-backed security. A mortgage-backed security is basically a big-ass loan with a bunch of other loans inside of them. Okay, so I won't call it a big loan, but it is a big loan in the sense that, you know, it is a multitude of different loans existing within one security. Okay, and now that security has it has an equity curve. It goes up and down. Okay, if there are failures inside of this here, then guess what? The security defaults. All right, and if everyone inside of this package here has a AAA rating and they're very likely to pay back their loan, then guess what? It is selling at a premium. All right. So what banks were doing, banks were going to Fannie Mae, because what Fannie Mae does with these mortgage-backed securities, I'm now having to draw this over here. Okay. So what Fannie Mae is doing with these mortgage-backed securities, all these loans that were created via the bank, subsidized via the cash given from Fannie Mae. Fannie Mae can take these mortgage-backed securities and sell them on the market to Deutsche Bank, to Goldman Sachs, to Bear Stearns, to Lehman Brothers, to all these different institutions. And those institutions can sell those mortgage-backed securities back and forth to each other. And as these fluctuate in value or appreciate in value, depending on the credit rating of the existing mortgage-backed securities, those investment banks make money, okay? These investment banks here. All right? And as these investment banks make money, Fannie Mae, what she does is she promises to these investment banks here, okay, we'll call these IBs. She promises to these investment banks that they are guaranteed to have an income, a fixed income based off of these mortgage-backed securities here, all right? So basically these banks have a guarantee that these mortgage-backed securities will be paid to them. I mean, basically they will exist, they will not default. And since they will not default, the banks are paying Fannie Mae an interest payment. All right, so that part is the most important part because Fannie Mae loves interest payments. She loves them a lot, and so does Freddie Mac. She loves them so much that she started telling these institutions here, hey, we want more loans, because the more loans we get, the more mortgage-backed securities we can create, and the more mortgage-backed securities we can create and package up, all right, the more we can sell them to other member banks in the FDIC, and the more interest payments we get. So these member banks here were like, okay, so then what happened? You, the Arby's employee, could just go to Wells Fargo or whatever member bank and probably get a house loan for over $300,000. You could have a FICO score back then of 500 and end up living in some little mini mansion. You know, so think about it, okay? Now you have all of these new mortgage-backed securities from a bunch of Arby's employees, Chipotle, McDonald's guys, all right? They're all packaged up and they all have horrible credit ratings. Okay, so what these institutions were doing were they were looking at those lenders and they were saying to those lenders, hey, yeah, no problem, you're approved, you're approved, you're approved. They were approving everyone, all right? Fannie Mae was fine with that because Fannie Mae says what mortgages they are going to subsidize. Okay, so remember this process here. The banks lend out capital. Those banks send those mortgages to Fannie Mae, and then Fannie Mae gives the banks cash. Well, Fannie Mae likes to know what mortgages they're collecting. And Fannie Mae saw the mortgages were owned by nothing but retail people with horrible FICO scores that were very likely to default. But they didn't care because as long as they could send it over, package up those mortgages to look pretty to where those mortgage-backed securities, those bonds had a AAA rating, then they knew that these institutions would buy them and trade them. All right, horrible, right? So what ended up happening was what you expect and what you already know. These mortgage-backed securities, which were rated AAA and diversified, they all collapsed. Okay, they all collapsed and they were all defaulting, and these institutions, some leveraged, okay, 300 to 1. Lehman Brothers had a leverage of 300 to 1, all right? So they bought a lot of this crap, okay? And they probably were buying the worst of the worst. And their entire business at that point, a 140-year-old bank, were built on the back of horrible mortgages. So that's why you can see one of the largest banks in history, that's why it collapsed, okay? So the government wanted to stop that process. The government was like, holy crap, okay, let's intervene, all right? Some people were against this and some people were for it. But now we have to draw up over here the new bank, okay? The central bank, all right? Another institution controlling money, okay? And now this new institution was looking at this entire process and they were like, okay, what the hell is going on? And then like Fannie Mae is basically saying, hey, look, none of these investment banks want to buy our mortgage-backed securities anymore. So then you have the central bank say, okay, well, how many mortgage-backed securities do we need to buy to stop this capitulation of the economy? Then Fannie Mae and Freddie Mac, they go and say $1.9 trillion in mortgage-backed securities. Boom, $1.9 trillion is now in the central bank's balance sheet, all right? They stopped the financial markets from collapsing, which is basically the bailout packages that you heard about when these banks were failing back in 2008. So earlier I mentioned to you guys that mortgage-backed securities occupy $1.9 trillion of the Fed's balance sheet. Okay, but even earlier I said that the Fed's balance sheet is $4.5 trillion. So where's that other money at? Okay, we added $3.8 trillion to the balance sheet because before we did the stimulus, we had $800 billion on the asset side, okay? Well, we increased those original assets, all right, to 2.5 trillion, okay? So we increased those original assets. Those original assets were treasuries. All right, so treasuries, just literally bonds, right? So you have the 5-year treasury, 10-year treasury, you have 30-year, you have the 30-year bond. All those instruments there were bought up again by the central bank. The central bank printed capital and put that money into the economy there. All right. So currently, right now, this is where we're standing. All right, we're standing at $4.48 trillion dollars under assets, so to speak, for the Fed. And what the Fed wants to do is they want to start lowering this number here. Now, again, obviously, folks, this isn't just some lame-ass macroeconomics class. This is definitely going to be bringing us back into the chart. Now, the important part about this whole process is in terms of how this relates to the Euro USD and, I mean, the USD overall is the interest rate and the bond market. Okay, a lot of times these major macro players say the bond market is the FX market, okay, or the FX market is the bond market because the FX market is driven by yield curve. We're not going to go into all of that, all right, but one thing we have to worry about is the tapering of the balance sheet, okay? Tapering means reduction of, okay? So currently right now, how are we going to reduce the balance sheet? Well, the plan is to reduce the balance sheet by $10 billion every month. Okay, we're still not yet at that place where we need to worry so much. Where we need to worry is how that tapering is going to start increasing, all right? $10 billion is where they want to start, all right? And we need to see what they talk about on Wednesday because if they stick to this plan, then, then we're looking good, all right? There might not be too much volatility. If they go against this and they say, hey, we're not going to start tapering this year, then you will see a weakness in the US dollar. Okay, because that's really bad that's bad economics for the US, all right? So if we stick to the plan, which is starting $10 billion in terms of letting these assets here mature, currently what they're doing is every semi-annually, when these treasury bills are maturing, they're getting an interest payment, right? Well, right now, what the Fed is doing, they're taking an interest payment and reinvesting back into treasuries. Okay, so that's why the balance sheet, I'm going to show you guys a chart right here. The balance sheet hasn't gone anywhere. All right, and you guys will see all three hikes and all three quantitative easing reforms that happened in the United States. Okay, there's that chart there. Okay, so currently right now they're reinvesting that capital, keeping us right at that $4.48 trillion number. But what they're going to start letting do is they're going to start letting these things mature. And as you guys should know, when bonds mature, eventually you get your money back and you no longer have a bond, which means that the balance sheet will shrink. Okay, these treasuries right here. Now, the interesting thing is earlier this year, the Fed said they are not going to start doing balance sheet reduction, aka they're not going to keep reinvesting the interest payment that's coming from these treasury bonds back into more treasury bonds. They're not going to stop that process until they normalize the Fed fund rate. Okay, right now we're at 1.25 in terms of a Fed fund rate. We've heightened 4 times since the collapse. Okay, once in December, once in March, and once in June. They mentioned earlier that they were not going to touch the balance sheet until we normalized interest rates, aka we had a higher uptick in interest rates and we were looking at inflation increasing. But as you guys know, all right, we haven't seen that inflationary uptick. We did have a good CPI reading that came out. We came out at 245 in terms of a CPI. We really, we matched expectations and beat expectations just a bit. But as of right now, we had certain things that are going to have implications that might weigh down the economy, all right? And those things are literally just, weather conditions, all right? So when hurricane season arises, the Fed and monetary policymakers and economists really don't know how the economy reacted based off of, again, the flurry of buying that happens, right before the storm hits and the after effects of investing in certain areas of the economy, okay? So those are going to have implications on what we're looking for in terms of monetary policy, but not so much. Those are short term. So it's interesting to note that they want to start doing the tapering, okay? Irregardless of inflation not really giving us that uptick to that 2% number that we're looking for, all right? But that is null and void at this point. So the problem isn't lowering the balance sheet. The problem is the velocity at which the balance sheet is reduced, okay? So earlier I mentioned to you guys that $10 billion of these treasuries and mortgage-backed securities are going to be matured month after month. They're going to let those mature, all right? And that's split like this. $6 billion is our treasuries and $4 billion are mortgage-backed securities, okay? And that's going to happen, again, month after month. Now, they're going to increase the pace. They're going to be increasing the pace by $10 billion every quarter, okay? So in another quarter, you're going to have $20 billion. Then in another quarter, you're going to have, $30 billion and so on and so forth. And what people are afraid of is by the time this thing gets to, $100 billion in balance sheet reduction and $150 billion in balance sheet reduction month after month, okay, is the economy going to be able to support that? All right, let me draw this up for you real quick. So I want to show you guys real quick, just imagine this is growth of an economy that never had to do quantitative easing. Year over year, you're going to hope to have economic growth. And as economic growth is happening, you're hoping to have inflation as well. Remember, if the population increases, then you have the job market is going to need to account for those people. And if the job market needs to account for those people, then you need to have more money circulating within the money supply. Okay, so that's what economic growth is supposed to look like. Now, what happened was during 2008, you had a ballooning happen. You had too much growth happening within the economy. They tried to raise interest rates. They tried to do all these different monetary policy techniques to slow the economy down, but it didn't work. So what they needed to do was this uptick right here. Imagine this to be inflation or the money supply. They had to do this. They had to throw the money supply to all-time highs to account for the collapsing economy. So they had to print more capital, okay? Taking the US dollar off its trek of that 5.7% inflationary increase year after year. So we increased rates, and as I showed you guys earlier, we increased rates, and right now we flatlined. Now what the Fed wants to do is they want to take some of the extra capital that exists on their balance sheet and they want to start tapering. They want to start taking it off their balance sheet, okay? And they want to do that again month after month, and they want to do that at somewhat of an accelerated pace. And they want it to meet back to where we should be, all right? So the balance sheet is going to be larger than where it was in 2008. Back in 2008, the balance sheet was around $800 billion. By the time we get done tapering, well, we're definitely not going to be back at $800 billion. We're probably going to be back in the trillions of dollars. We may still be in $2 trillion or maybe $1.5 trillion, okay? So again, the problem is the market going to be able to sustain? Remember, they bought mortgage-backed securities, okay? There are treasury bonds that that the bank bought, and if they redistribute those bonds back into the market, there could be something called the taper tantrum, all right? And the taper tantrum, I'm gonna throw you guys some screenshots, was a really big deal back in 2013. Back in June 2013, not Mario Draghi, but Ben Bernanke mentioned that he was gonna stop this process of quantitative easing. He said he was gonna stop it in 2014. everyone in the bond market freaked out and started immediately selling all the bonds because they feared that the market wasn't ready for that. All right. It was the last time that we have actually increased the money supply. But again, there was a lot of frenzy and there was a huge flurry in the markets. All right. And what the Fed doesn't want to do, they don't want to taper tantrum part 2, where they start tapering. And when an increase happens in tapering, then everyone starts freaking out and starts selling off all of their bonds because, again, they feel as if the market is collapsing. You guys get what I'm saying? All right. So again, this is something that is really important that you're going to have to keep an eye on and that they are talking about. If the market can't sustain all these little homes that are bought, all these bonds that are bought, that are held up here, if the market doesn't take those on, okay, the private sector, if they don't take those assets on because they're ready to start investing back into the market again, then guess what, folks? You're going to have another scenario where you're going to have a financial market collapse. You guys get what I'm saying? No one's going to want to buy these. And if no one wants to buy these, you're going to have more defaults and you're going to have another situation where, again, we go back into a recession, which is what they want to avoid. So the reduction isn't so much of a big deal. The velocity of the reduction is a big deal. And the ancillary markets that surround them decreasing their balance sheet is a big deal. The bond market, which is something that we're definitely going to have to talk about here in High Impact, okay? So that's what's going to be talked about on Wednesday, guys. You guys need to keep an eye on anything involving the balance sheet, anything involving tapering, obviously anything involving the Fed fund rate. Just to throw it out there to you guys, right now we have a 50% chance of heightening rates in December. If there's any sign that they don't want to do that and we want to wait until 2018, we're going to get a weak dollar, okay? And if we get a weak dollar, we know the pairs to play, okay? We know the pairs to play, okay? We can play that on the NZD-USD. I love that pair. For this week, we can play that on the euro. Don't want to play that on the pound too much. Pound is already pushing out up to those highs. And I will probably be liquidating my US CAD position, okay? Because I'm long US CAD right now, all right? So guys, your profit, always my motive. Give me some advice on what you want me to talk about in High Impact. We're definitely going to be doing NFP when NFP comes out and a couple other things, but I want to know what you guys want me to talk about, all right? And always like the video for your boy. Let's see what we get this week, okay? I'll talk to you guys real soon. Peace.